session. It's following up with a gain of closer around 10%. TCNS, well, that's another stock that's up closer around 7%. Or the street is a buzz that maybe there could be a potential deal in the works. So that one is up 7.5%. And just to note a couple of other earnings reactions, Parag Milk, I think, came out with its set of numbers. That stock is up close to around 7% as we speak. So just a few more names, Prashant, I thought I'll highlight from the broader markets. But boy, there's a party going on in the broader markets.
Oh, absolutely. And this is, basically picking up from where we left off on Friday, because big volume-led activity is what we've seen on Friday. We saw that on Thursday, and actually over the last many days, even as the indexes played catch-up with the broader market. The broader markets have done very, very well. More names in a bit from now. We are at 18,121. On the Nifty, which means that from the highs we've come off a little bit. The high is 18,145, so we're about 20 points away from the high which was made right at open. Now, Shailesh Rajbhan is Chief Investment Officer, Equity Investments at Nippon India Mutual Fund. Shailesh, great to have you with us here on the program. Good to have you back on the show as well. Prashant here. Shailesh, how are you, do you think we're very close to previous all-time highs, about 4% in the Nifty, 2% in the Bank Nifty, but do you believe there is enough in the mix which leads you to believe that we are in for some bigger and larger, more meaningful moves from here beyond the next 2%? What's your sense?
Directionally, we have seen a meaningful time correction in the last 18-19 months. That gives a lot of cushion in terms of, the excess froth in the markets not being there. Interestingly, in the same period, we had reasonably weak earnings in the last 2 or 3 quarters. And I think as earnings from here on start improving, because it's a journey still, earnings don't ramp up in 1 quarter. But I think directionally you would find earnings improving from here on, which plays out a lot in terms of how the markets are optimistically looking at the near term. More importantly, the international factors, if you look at, except for US, where the struggle still remains, I think the worst for Europe, the worst for China and all seems to be behind. And I think all this should support general stabilization and recovery in demand. India does depend a lot on global demand, and I think that will support our earning recovery as we get into in the next 2 to 4 quarters. And I think that's what markets are looking forward to.
All right. Hi, Shailesh. Good to hear your optimism on the earnings growth. But what are you factoring in? I missed that number because, many on the street believe that mid-teens for next 2 years, that's gettable, but that could be at risk. What are you factoring in?
Yeah, so if you look at it, the base, in the last 12 months now, earnings have been weak. At least 3-4 quarters have been fairly weak earnings after the COVID recovery and rebound which has happened. On this base, getting to, 12-13% should be fairly comfortable, and the global growth remains good. I think, it could play a little bit higher than what we are looking at. So I think earning uplift seems to be an important opportunity in the next 2 or 3 years, and I think that seems to be, at least the construct is right and ready for that, 12 months out, you would be possibly in a better global growth environment, which in a way would lead to better support to our exports, better support to our earning growth. So I think we would look towards maybe 12-13% kind of broader earning growth over the next 2 years, with some chances of acceleration if things remain normal.
So for example, this earning season so far, Shailesh, right? After Q3, we saw lots of downgrades. Are you seeing that signs of, in management commentary, in portfolio companies, signs and hopefulness of earnings acceleration?
See, it's a little too early because, we have seen a few sectors disappointing, a few sectors doing okay, but these were in line with expectations. So banking was likely to do well, it's done well. IT services had to see some struggle and it was visible. I'm looking, say, 2-3 quarters out, 2 quarters out, when the base effect of last year's strong recovery also wanes out, right? So from where we stand, say last 2-3 quarters have been low single-digit kind of earning growth. From here on to accelerate to 12-13% is a doable task, maybe in the next 3-4 quarter period, and then accelerate further because the investment cycle would kick in, the stability in terms of global demand and recovery could kick in the next 3-4 quarters, and that will support taking the current high single-digit earnings to the early double-digit level. If in terms of commentary, I think there is no increased pessimism. I think in some pockets there has been recovery in March and April. In some pockets there has been deterioration. I think it's purely got to do with the initial distortion which happened, where you had a very sharp rebound, very sharp increases in price due to inflation. I think that is middling around. So I think 2 quarters out, the strength of the earnings should start getting visible to the levels which we are talking about.
All right, Sailesh, I wanted to particularly ask you about the pharma space. I think I was looking at the Nippon India Pharma Fund. I guess you'd be the one that would be involved in that. And last 1 year hasn't been great, but otherwise, the last 3 to 5 years, you'll have outperformed the market, at least this particular fund. What's your view on the pharma space from here on? Many throwing in the towel. In fact, we had, the management of Laurus Labs, and everyone saying those numbers were really weak. The management was fairly cautious. But in fact, post the numbers, the stock rallied 5%. How do you position yourself on pharma from here on?
Interestingly, I think this could well be a very, very important turning point for the pharma sector from a earning recovery point of view. And that is what I think will really matter, because markets in the shorter term do really look at how the near-term earnings are performing. We have seen meaningful price increases in the domestic side. We have seen a reasonable recovery in demand on the domestic branded side. And I think that is what is now going to determine the larger profit growth for Indian pharma companies. Select segments like, API continue to remain weak, but I think it's a function of now last 12-18 months of weakness, and it should get better from where we stand. But the biggest opportunity for Indian pharma lies in the domestic branded space, because I think the whole opportunity there is way bigger than what we really think, because of the scale which we are in, because of the chronic nature of the problems we are in, and all those. So I think the pharma space is now seeing a large part of the profits coming from branded, domestic, sustainable business. And I think that will allow for a earning growth of this sector to start getting much better. In fact, earnings have been patchy for the last 4-5 years in the sector, except for the COVID recovery. And I think that allows for a reasonably good recovery in the next few years, given low basis, and also the rising mix of, like I said, the domestic profitable business.
By the way, the markets turned around very quickly, and we're at the day's high. 18,158 on the Nifty is where we are at. So if you can have the index up, I'll tell you the story. And similar, I think, would be the case for the Nifty Bank as well, which is up 0.45%, and we're at about 43,435. So about 1.5% from new highs on the Nifty Bank. We're at the day's high, by the way, on both these indices. 92, 93 points now on the Nifty. Two names from the retail space which are jumping. One is Shoppers Stop. It's up 6.5%, 7% right now. And the other is TCNS Brands, which is up 8%. So TCNS Brands was, I think, even last Thursday, Friday, stock did well. But there's Shoppers Stop, which is also now doing very well. Sailesh, is the mutual fund industry going, or for example, you at Nippon, increasing exposure across mid, small caps, etc., in a more aggressive, concerted kind of way? Is there a view really on that part of the market?
Yeah. See, if you had asked this question about 6 months back, where there was not much of an opportunity in terms of valuation gaps, in the last 4 or 5 months, we have now seen select sets of mid and small caps having corrected, and that has allowed for some opportunity to move around there. In fact, many sectors which were kind of have been tailing off a bit, providing opportunity. So there is clearly some sense of reasonable risk reward coming about in mid and small cap spaces, more so in the small cap side, where the participation has increased. In fact, the valuation differentials, in fact, a lot of small caps and mid caps have underperformed for quite some time. And while the large caps have remained fairly stable, that has provided selective opportunity to participate. Is the valuation so attractive that there is a big differential whether one should choose mid and small cap over large cap? That's not the current situation, though. But I think clearly selective opportunities have emerged in the small and mid cap space in the last 4 or 5 months now.
Okay, all right, Sailesh, always a pleasure hearing your thoughts. Thanks so much for joining in and, in fact, filling us in with your view on the markets. We're going to track the earnings growth as well as the pharma space. Looks interestingly poised as well. Well, time to move on then. Numbers are coming in thick and fast over the weekend. So let's focus on one such number which looked like a rather weakish set of numbers, that of SBI Cards. The net interest margins came in at all-time lows. The revolver rate as well as low, while the credit costs remain elevated. But we want some clarification on the way ahead, because the street believes there is still plenty of hope and plenty of potential going ahead. The stock is up 1.3%. Mr. Ramamohan Rao Amara, the Managing Director and Chief Executive Officer, joins us on the show. Hi, Mr. Amara. Good morning. Thanks so much for joining in. We are swiping along, but the results are not really showing that. Looks like the mix is, not turning around as of now. So the most crucial part for your business from a stock market perspective is going to be the revolver contribution from around this 24% odd. Do you think it's bottomed out here? And do you think we can increase? Say for the next couple of quarters, you're unable to give us a number, but by the end of this year, where do you see this number headed?
Good morning. The way to look at it is during Q4, March 2023, the NEA grew by 30%. And revolver portfolio in absolute amount kept pace with this NEA growth. And that is the reason it was stable at 24% as compared to even the previous quarter as well. This has been the result of various actions what we have undertaken in terms of attracting more customers who are self-employed and new to credit card who have a higher propensity. So we have seen the positive trend in the Q4. For the kind of steps what we have taken, we are hopeful that it may improve, but we will not be different from the industry in general in terms of the revolve behavior. But the way to look at it is that we are also focusing on the overall interest-bearing NEA, where it increased by 2 percentage points from 59% last year to 61% as of March 23. That way, we are looking at ways of optimizing the revenue, and that's the reason our overall result in terms of ROE is on expected lines.
But sir, Mr. Amara, I request you for a couple of numbers, sir. Revolver, where does it go? Because that's going to be the re-rating event from a market perspective. Where do you see the revolver rate as a percentage headed from this 24%? And also your NIMs, well, it's come down quite from mid-teens, it's come down to around 11.5% odd. Cost of borrowing could go up a little bit from here. So what's the number we look at in terms of NIMs?
Revolver, given the kind of trajectory what we have seen in the past, while we continue to take actions to promote the revolver, it's difficult to predict how much it will improve. If you ask me whether it will improve, but by when and by what extent is difficult to predict. But coming to the cost of funds, given the kind of balance sheet structure what we have, we guided the market in the past that actual cost of funds will rise by up to 40 basis points. We ended Q4 with a 39 basis point increase, a large part of which we were able to absorb by transmitting increases in the new disbursements. So that's the reason we were able to contain the NIM compression to just 5 basis points, while the cost of funds actually increased by 39 basis points. So we will continue to have the opportunities to transmit the increased rate in the portfolio. So we are very confident of NIM stabilizing in a quarter or two.
Okay, NIM stabilizing in a quarter or two. Mr. Amara, good morning, Prashant here. So just to take that point forward, can cost of funds, is it possible it goes back to 8% kind of levels, pre-COVID levels?
Given the current rate environment where RBI has also paused and looking for more cues before they take next action, I think we are expecting only 10 to 15 basis point increase further in the cost of funds in the next quarter, whereafter it will stabilize. But the yield will catch up. Already yield has improved by 35 basis points in the last quarter. Yield will continue to catch up. So the NIM compression will be behind us in a quarter.
Mr. Amara, just one more question. While you were at the number 2 place, when one counts the number of cards in force behind HDFC, your share of spending, though, is not keeping pace with the rest of the industry or the leader, for example. And hence, I'm assuming that impacts market share, etc. as well. What can you do to change that?
Spend is a play of both the retail spend as well as the corporate card spends. Retail spends have grown at a very robust pace. 41% is the kind of year-on-year growth what we achieved. While the card base has increased by 22%, the per card retail spends have also increased by 9%. Corporate card spends actually complements the overall spends. It helps in market share. So we do have a calibrated play in this game. But we want to keep the corporate card spends in a narrow range of 22 to 25% of the overall spends because it doesn't add much to the bottom line. So we will be taking every effort possible to bridge the gap between our SIP market share and the spend share, but we will also be mindful of pursuing a sustainable and profitable growth.
The other thing that the street is a bit worried about is the way the asset quality has deteriorated on a quarter-on-quarter basis. Can you tell us whether there is more pressure that's expected in asset quality, and what is the, what could the gross NPAs look like by the end of the year?
For the record, credit cost for the entire year FY23 is at 5.9%, which is a 230 basis point improvement over previous year. Having said that, Q4 had some different trends where any GNPA increased marginally. The credit cost came out at 6.3%. But if we account for one-time kind of changes in the model, which had an impact of around 20 basis points, it was at 6.1%, which is broadly in the range of 5.8 to 6.2%, which we guided in the past. Coming to the analysis of the problem, we did identify a small segment of the portfolio out of legacy portfolio, and that means before COVID, which was exhibiting some higher delinquency. We have taken certain portfolio actions. These will have a positive impact, and the credit cost will trend downwards after a quarter.
Okay, that's on credit costs. But the other two internals, which are also a bit worrying, is that the number of new accounts have gone down 16% compared to last quarter. And the spends per card has also gone down almost 2% on a quarter-on-quarter basis. Now, is it just that, is it a problem specific to SBI Card, or in general is the card industry facing this kind of heat at a time when sort of maybe UPI or other payment portals are doing better? Just trying to understand the dynamics of the market currently, and do you think that there could be more pressure in the new accounts generated over the next few quarters?
I think our new account volume in FY23 was at 5.2 million, which was the highest for us at a 46%, which has also actually helped us gain market share by 100 basis points. Quarter-to-quarter variations, particularly if you're talking about Q4 volume being slightly lower than Q3, was more of a result of some recalibration of the credit filters, which has reduced. But we will always aspire for a 1 million net growth card addition in a quarter. So gross is more like a ways to achieve that, but the objective is to have a 1 million net growth in the cards while keeping an eye on the market share and keeping an alpha above the market growth.
I understand that it's difficult to forecast the revolver share, but it used to be at about 32-33% earlier. Should you assume that 32-33% is now history and will never, perhaps you never reach that level? What is the possibility over the next couple of years, according to you?
Given the kind of changes that happened, the extent of choices that are available, the extent of competition, and the kind of regulatory guidelines, so I think aspiring for 33% in a very, very short span of time is not possible at all. But if you ask me whether it is going to increase, given the kind of steps what we are taking, particularly when we are going into NTC and NTCC kind of customer segments who are loyal and for whom the credit card is the first time they are using the credit card, there is a possibility of increased propensity of revolving. So we are hopeful of improved or increased revolver, but very difficult to speculate the level at which it will be after a year or two.
All right, Ms. Amara, thank you very much. Great speaking with you. Appreciate you joining in and running us through all of the detail as far as the numbers are concerned. I mean, the market's up a full 3 digits now, 100 plus points in the Nifty, which means we're at the day's high. 18,170 is where we are at. This is, I mean, a nice takeoff from where we left off last Friday. Now, the next corporate to talk to us is CSB Bank. I mean, the company recorded a strong loan growth, especially the non-gold portfolio grew very well. But there was disappointment on the net interest margin front. So let's understand from the management what happened and what is the way forward as they see it. Pralay Mondal is Managing Director and CEO at the bank. Pralay, good morning. Great to have you with us here. Thank you very much for your time. So just to kind of paraphrase the numbers for our viewers, net interest margins in the quarter fell about 40 basis points, 45 basis points actually, to about 5.4% or so. Could you tell us what is the way forward? This is largely on account of a rise in cost of funds, etc., and also high cost deposits. What should we expect in the next couple of quarters? And I mean, if you have a guidance for the full year, that will be helpful. Go on.
Thank you, Prashant, and thank you for having me. And good morning to all your viewers. I was just watching a previous interview with SBI Cards and was giving me nostalgic feelings of my building up the IDFC Bank portfolio more than a decade back. But coming to CSB, And the NIM which you're talking about, I have been guiding it for the last 3 quarters that we are quite happy with a NIM of anywhere around 5%, and this is significantly above that. And I said before, and I'm repeating it again, that we will not sacrifice growth for NIM. And you saw that we had a 30% growth in assets and 21% growth in deposits. So we are building a franchise, and a few basis points here and there on NIM won't really matter at the end of the day. Having said that, we are conscious, and when you see the overall repo rate has gone up so much, and to acquire the right kind of deposits in the growth, last year we grew by 5% in deposits. This year we have grown by 20%, 21%, and hence obviously there will be some cost of that accretion. Having said that, we must understand that overall GSEC curve is flattening, and as I saw today morning, it was 7.12 10-year GSEC. So gradually we'll see that stabilizing. We are already seeing this quarter the cost of deposits are stabilizing and sort of showing a slightly lower trajectory for the incremental deposits. So I'm not too worried on this.
All right. Hi, Mr. Mondal. Good morning. The street clearly was a little bit skittish because of those NIMs. And the problem last quarter was that the cost of deposits went up drastically, but the yields on advances didn't go up so much. But as you're saying, 5% will be maintained, so we take that. What about the loan growth? I think you were hinting at around 20-25% odd. What should it be for this year? If you could help us out with that. And I'm just looking at your release. Your other operating expenditure has surged up by 40% year on year and 24% quarter on quarter. Was there any one-off out there?
Not really. I think we'll continue to have a slightly higher operating cost for 3-4 reasons. One is we are really building up the tech stack, as I said in the last interview also, because we are building the bank at this phase. And hence our entire technology stack will change, and there's a heavy lifting on the technology front this year. So you will see operating costs going up. We are also expanding our people front, whether it is leadership or front-end sales acquisition. We need a lot more customer acquisition in the bank because we are building across the and breadth of the country today. So an incremental 100 branches, we are putting around almost 60 branches in north and west part of the country. And hence, those operating costs will keep going up. The third, of course, is we are investing into other channels and other products and services because we don't want to be a pure play gold loan bank. So we are investing into retail products, SME products, transaction banking we have launched. So a lot of other things which you're doing which will add costs. But each of these costs will...
So got it, Mr. Mondal. So you are, sorry for interrupting, but so we get the point. The other operating expenditure will remain elevated because of the factors you're mentioning. What about the loan growth? What kind of a number we could look at?
I think one more point I want to add that these operating costs are not really costs, these are investments, and these have a payback period. And with a lag, this will come down, and have long-term 2030 vision for cost to income is around 40 to 43%.
Okay. Loan growth, sir?
Loan growth, I think we did around 30% this year. I've always said that we'll be around 30 to 50% faster than the system. Given next year nominal GDP will be 10 to 12%, and hence we expect the loan growth to be around similar range. That's what the predictions are. We should be able to at least grow faster by 50 to 70% of the system next year.
So, so 10 to 15% nominal GDP growth is what your growth will look like, right? So is that what we can assume, a 10 to 15% growth?
I said that's where the industry growth will be. That's where the industry growth will be. We will be 50 to 70% higher. So we are not looking at any 20%. Yeah, we are not looking at anything below 20%. And it is difficult to believe that we won't be able to achieve at least a 25% kind of a growth.
Okay, got that. So 25% growth is what you're targeting. That's the more achievable growth for you in FY24 as far as loan growth is concerned. I want to understand if there is any inorganic opportunities that you're looking at because you are highly capitalized. And earlier, I think you had mentioned that you may bid for an inorganic move. Some people are talking about Bank of Maharashtra as well. Do you want to quash any of those rumors? Anything that's still on the horizon for you?
I don't remember ever talking about an inorganic opportunity. Having said that, we always look at portfolios. Whether it is a MFI portfolio or a retail assets portfolio here and there. but nothing has fructified so far. So we are looking at organically growing the bank very aggressively. As you saw that our risk-weighted assets and our capital consumption on the SME side of the business is going up, which is good news because we are now going beyond gold and also building other businesses. As our retail assets and other businesses grow up, the capital consumption will keep going up for the right reasons. So we'll see that organically will continue to grow. And continue to grow around 25% higher organically. And if there's any opportunity comes, we'll look at it.
Okay. Mr. Mandal, just a last question from my side. You know, your non-gold loan book has grown very fast, the fastest in many quarters. Actually, that's about now 50% of your incremental credit loans given out. And you guided that you plan to grow that. What is the will credit costs, etc., also rise because of that? Because gold loans have, I mean, the rate of growth in gold loans has slowed down, but it is still, you know, very low. I mean, non-existent in terms of credit costs. Not so much on the other side, which you plan to grow, and rightly so. So, just some thoughts on how this would pan out.
So I think it's a very important question you're asking. So let me just explain this little and give me a little time on this. The gold loan will continue to grow at least for 1 more year at the similar rate, and gold loan grew very well last year as well, because we need that business to fund our growth in the other businesses, because those are infrastructure and investment heavy. So which we are going to do in the next 12 to 18 months. Having said that, yes, SME grew well, wholesale is starting to pick up, and transaction banking we're investing. So to that extent, I think, yes, what you're saying is right. We will see gradually tapering down of the gold loan, but not next year, from FY25 onwards. But also we have to be conscious. You saw some of the reports coming from RBI and various other sources that on the retail side, one needs to be a little cautious. On the unsecured side, the growth has been very fast and things like that. So we also don't want to pick up the wrong side of the cycle at this point of time. So we are building our capabilities and processes and technology and customer acquisition on the liability side. Once we do that, we'll pick up on the retail assets only FY25 onwards. Meanwhile, SME will grow. So it will be more in next year as well, Sonia. Yeah.
Sure, got it. Just one final question, and if you can keep the answer short, because, you know, we're running out of time. You said that if any inorganic opportunity comes your way or willing to look at it, are you looking at a bank, or is it an NBFC that you have in mind in order, you know, to take that acquisition opportunity forward?
At my level from CSB Bank, I can only look at a portfolio. Beyond that, I will not be the right person to respond.
Okay, all right. Thanks a lot for joining in and appreciate your thoughts. We'll slip into a break. On the other side of the break, we have R. Subramanian Kumar of RBL Bank to discuss their Q4 earnings. Post that, we have V. Vaidyanathan of IDFC First Bank to talk about their Q4 numbers as well. Stay tuned. Welcome back to Bazaar Morning Call. Well, for now, we have the management of RBL Bank joining in. It was sequentially a good quarter, but the stock is under quite a bit of pressure. It's down almost about 3.5%, so do keep that in mind. That could possibly be because of the slower growth that the company has seen, the bank has seen this time around. So R. Subramaniam Kumar, who's the Managing Director and Chief Executive Officer at RBL Bank, joins in now to give us more details on what the way forward could look like. Mr. Subramaniam Kumar, thanks a lot for joining in. Can you start by telling us about what the growth would look like in the subsequent quarters? Because if you look at it, NII growth has barely been about 7% compared to same time last year. On a quarter-on-quarter basis as well as just a 5% growth that we're looking at. On the both NII as well as on the loan growth front, what is the expectation for the bank in FY24?
Yeah, NII growth, if you look at it, is 7%. Is mainly because of the fact last year we had a one-off in respect of around 72 crores, which had to be added at the last minute. It is because of that earning which come from the restructured book, which are kept it in a suspended interest. But it has been at the insistence of the auditors, it has been added. You know pretty well the restructured book was just moving up. Whichever has been recovered, it has been accounted for. Which has not been recovered, it has been reversed. That's one of the major reasons for the NII. If you just look at it sequentially, if you look at my NII, it is just growing. Moving forward, and one of the major things which we have done is a business model reformatting. So the reformatting of the business model has taken it in 3-4 things we said to the market when we just started the year before. One is we will be growing at around 15%, right? But we clocked at 17% as advance growth. We also said that annualized retail growth will be to the tune of around 20%, but we have clocked actual growth of 21% and annualized growth of around 24%. So these are the two things which we said. We also said exit ROA will be 1%. In the Q4, we were able to do an exit ROA of 1%. Going forward, we will continue to maintain our credit growth, overall credit growth in the range of 20% plus. And as far as the retail is concerned, we will be in a position to grow to the range of 24 to 25% going forward. This is one. Second, we will continue to maintain our ROA at the trending which has been happening now. And we will be able to add around 10 bips to 20 bips year on year into the ROA as we move forward. And the focus of the strategy will be, as we said, that the ratio of the retail and the wholesale will be, it was around 50-50 the year before. Now we have 46 and 54. Going forward, it will be 60 retail and 40 wholesale. Within the wholesale, we are just doing certain readjustment and reformatting. So we are focusing on a commercial, which is going to give me a little edge over my margin. Today, the corporate book, as it is giving around 0.75% as a margin. Moving forward, we want to inch it up and nudge it to around 1.5. So 40% of the book will continue to give, 40% of the book will continue to give me around 1.5% as we move forward. And in respect of the remaining 60% retail, we have been clocking in credit card and microfinance. Microfinance has grown, which was a stagnant book earlier, which will continue to grow. And we have launched around 6 products. All the products are showing traction. Last quarter, housing loan alone had around 900 crores of disbursement. In the retail disbursement for this year is double of that of
got it, sir. Right, sir. So we've got a fair bit of details from you. I think you're targeting credit growth of 20%, right? Is what you mentioned. That's
exactly.
You mentioned a lot of numbers, so just clearing that, okay? And the ROA will improve by 10 to 20 basis points on a per annum basis from year on, from that 1% odd mark. Got it. Let's get a couple of more numbers out for you. You explained to us how you're moving around with your retail portfolio and how do you see the margins pan out from here. Give us a consolidated number. For the last quarter, you did closer around 5%. Given everything, all the measures that you're taking, as well as the cost of deposits, what should the number look like? What is the target in terms of NIMs? Also, what about the credit cost guidance? I think you were guiding for around 1.5% to 2%. So both these two numbers, NIMs and credit cost.
Absolutely. So NIM will continue to be in the range of around 5 plus, which we will be able to maintain it because our the credit growth is going to be primarily focusing from the retail side, which is just doing well. Going by the traction of last 3 quarters, we will continue to do well. And with regard to the credit cost, you would have seen in the numbers, we were able to bottom out and we have reached around 29 bips as far as the credit cost is concerned for the last concluded quarter. Previous quarter was 39 bips. Overall, the year was 149 bips when compared to the 500 plus bips of the previous year. We also narrated that we will be in the beginning of the thing, we said we'll continue to contain our credit cost. We also projected that we'll do 50% less than the last year, but we talked much below than what we said about it. Going forward, the credit cost will continue to be the major focus. and we are pretty confident of holding it around 1.5 to 2% range. That's exactly the going forward plan of action.
No, so gross and net slippages at a little over 4% and just under 2%. So could you, where do you see these numbers in FY24?
Yeah. You know that our business is having a credit card as well as that of the microfinance. Microfinance, we are able to bring it down fairly well, and it will continue to be traction at the low end. And the credit card will be the market-related one of around 4%. So credit card, whereas in wholesale, I can say that it's bottom out. And going forward, there will not be any slippage as far as the wholesale is concerned in this entire year as we move forward. I'm talking about the next slippage. And this will provide us enough cushion for making a statement that we'll be able to have a credit cost in the range of from 1.5 to 2%.
Okay, all right. What about the number of branches, sir? I believe that you're looking at adding quite a few branches in this year and the next. You have an ambitious plan out there. Give us a number of branch addition for FY24-25.
See, we added very few branches in the last half year. And here I just wanted to bring it to the notice of the viewers that we have 800 plus subsidiary, 100% subsidiary, which is a touch point of the branches. And this we wanted to leverage it first. The second is we already have 517 branches. Both put together, we will be in a range of opening around 60 to 75 branches during this year. And we will take the RFL branches, which are in the periphery of cities and urban areas. Some of them will be converted into that RBL branches. And RFL, as already pan-India, it is spread across. So far, we have been handling only one loan in respect of the RFL branches, that is a JLG loan. So going forward, we are going to leverage the BC channel. We will be focusing on all other activities which the BC can undertake as per the BC guidelines of the Reserve Bank of India. So this particular thing put together, and we have said about in 3 years' time, in 26, we will be touching around 2,600 touch points, combining both RBL and RFL. So this year we'll see around 70 to 75 plus addition.
Got it, got it. I just wanted some details on the slippages. The slippages have gone up to almost 700 crores compared to 608 crores last quarter. So that's a big up move. Can you tell us that whether there's further pressure that you're seeing there? Would the slippages move up further? And can you guide us, the slippages are coming in from which segment?
Yeah. See, you know that the slippages of the credit card will continue to be in the range of around 200, which we have been seeing it in the industry, and we'll try to contain that. And the slippages in microfinance has been totally brought under control because all the restructured book has become behind us. We don't have anything which is going to come up in front of us. And the retail book, which we are just building up now, will be definitely, that next 2 years will never be a problem as far as they will be building up fairly well. And as I said, that wholesale book, we had 1 or 2 accounts which slipped in the last year. Those are the things. We don't see any other pressure from the wholesale book in this year moving forward.
Okay. Thanks a lot for joining in, sir. Appreciate your thoughts. By the way, we need to get back to the markets. Just look at the way the markets are zooming now. 18,150 is here. It's up almost 90 odd points at the highest point of trade, led by a group of stocks, Tech Mahindra, L&T, Wipro. So it's a secular move across the board. JSW Steel, BPCL, Bajaj Auto are all your big winners in trade. So let's do one thing. Let us get our technical experts on board as well. We'll do that in just a bit. Take a quick break. Okay, Mitesh is back with us. So I think very timely welcome for Mitesh. Mitesh, looking pretty good for the market. The mid-cap index is up almost 300 points now. Do you expect, some more build-up through the course of the day, and any stocks that stand out for you?
Good morning again. I think, yes, there's a good chance that we'll see continuation of the up move today. And, as I said, I think the serious profit booking possibly will occur closer to about 18,250. There's another about 90 to about 95 points left on the upside. I think if not today, then by tomorrow we should be able to hit it, or maybe even today. So I think the broad momentum is on the upside. There was a gap up which was sustained, and there's no, danger of filling that gap immediately. Therefore, we must assume that the trend is on the higher side. Having said that, 2 stocks which I like a lot. I think emphasis from the IT pack after a long time is giving a breakout. So buy here with the stop below 1835, look for targets of 1920. And L&T Finance, I think there was a mild, negative concern about the numbers, but I think the stock has picked up well. The chart pattern is very strong, so I'll go with a buy here with the stop below 92 for targets of 98.
Okay, Mitesh, any thoughts on RVNL 10%, IRFC 6%, IRCON 7-8%, Texmaco Rail 6%? I mean, this entire railway pack is going absolutely bonkers, jumpy.
Prashant, disclaimer here, Ircon is part of my long-term portfolio. I think all these stocks, we were discussing them the other day when they'd gone up, and then during the afternoon session, they'd come down a bit. But all these stocks, looking at the medium-term charts, the breakout is very, very strong. The indicated position on most of the medium and the long-term charts is on the upside, suggesting that 20-25% further upside could easily happen in the next few weeks. So in the short term, if you look at the last 2 weeks of data, they've run up a bit. So maybe not a good entry point, but on a consolidation or on a pullback, let's say 5 to 7% correction, buy here. I think 25% upside is very easily achievable for all of these stocks. Disclaimer, as I said again, Ircon is part of my portfolio.
Okay, thanks a lot, Mitesh, for that. The market is looking very good right now, but let's also take some time out to talk about some numbers that have come through, and Lata is right here to take it forward for us. Lata, over to you.
Thanks a lot for that. Well, it's a very good performance coming in from IDFC First Bank. I mean, it's a mind-boggling 55% growth in deposits and 26% growth in advances. Net interest margins have jumped to 6.4%. Let's welcome the Managing Director and CEO, Mr. V. Vaidyanathan. Good morning, Mr. Vaidyanathan. Excellent performance. The market will be rewarding it. But 55% deposit growth, can you give us, I mean, is it sustainable? Was it a lot of bulk deposits?
So I think it's like 47%, I think, just to get the data right, or 49%. We got 2,131 crores from one large government deposit which came during the end of the month, end of the year, for 2-3 days, and by now it's vanished also. So we normally take it out of our numbers. So our real deposit growth is something like 45%. But we're happy.
But even that is very good. 45%. So even in that 45%, is it more of bulk deposits? I mean, your officers going and getting that number of deposits is a very big achievement. So I just wanted to know if there is more of bulk.
No. I called out the bulk to you. In fact, we are one of the people who actually call it out upfront in an investor presentation itself, by the way. We don't recognize that. But otherwise, except that amount I told you, there's no bulk in this. This is pure, high-quality, retail, sticky deposits. We are very happy about that, yeah.
Okay, but what is a sustainable rate, both in terms of advances and deposits? Even advances, 26%, right?
24%. And that's also very sustainable, because that's what we guide for. We say 22 to 24%. It's very sustainable. It's steady for our phase of the bank. We're relatively early stage. That's kind of should be expected of us. But on the deposit side, I think many people are surprised. People are calling us all over the place. Hey guys, how are you really doing this? But I'm telling them, listen, it's not the first, you're taking note of us today. But see, our last 4 years, our deposits have always been strong. Somehow this institution is seen as a very positive, strong, customer first institution. It's just coming.
How much did you have to increase your return on deposits, your rate of interest, over the year?
We took it up, in the first 10 lakhs, we pay 4%. And that we didn't touch all through the year. And by the way, for 2.5, that number.
That's savings, right? FD?
FD must have been going with the beat of the time. By the way, in FD, we don't pay very much of a premium over the big banks for information. We are kind of moderate. And the important thing is that after we dropped down the rate from 7% to 4%, most people called on, hey guys, you're going to lose deposits, people won't bring in money. Well, it's still growing at 40%. So I think the bank enjoys a good brand, and I thank all of you, everybody listening, for the goodwill act.
Okay. Well, the NIMs are obviously eye-popping at 6.4%. Now, along with it comes worries that you may be giving risky loans. So is, first of all, 6.4% sustainable?
First of all, NIM went up because we dropped the deposit rate from 7% to 4%. And that's like a good drop. And that helped us. The second thing about asset quality, you're absolutely very right. And this is something people should ask and we should answer. That our key parameter to watch actually is the fact that, our asset quality has always, gross interest, always been 2%. In fact, is now 1.65% or 1.6% on the retail side. The net NPA has always been 1%. Now it's 0.55%. So that is one data point. But more importantly, to give comfort to people, let me tell you this, that we are really specialists in the lines of businesses we do. Our collection percentage, and Lata, you should note this, collection percentage without taking prepayments into account and without taking arrears into account, pure EMI due, EMI paid, that is running at 99.6% for like a year now, 99.59. So if a collection percentage stays at 99.6, we won't have an asset quality problem.
No, you
We should be
won't.
watchful, of course, but I can tell you data.
Well, your retail book is up 50%. That's also a steaming rate of growth. How much of this is unsecured?
No, first of all, again, you should check your numbers. It has different components actually in it, but you know, some things like home loans are growing at 40-50%. Some of them are growing at 20%. Some of them at like loan against property is growing at 13-14%. So let me just leave it at that. What was the second question, Lata?
No, I was asking how much of your book is unsecured.
Yeah. Now on this front, we track this portfolio on cash flow of security. Close to about 90% of our book on the retail side is cash flow backed. And this is very important to note, by the way, don't take it trivially. Cash flow backed means there is money in the bank and we are dipping the money. It's like money escrowed there and we're pulling out the money from the bank. And there's no better security than cash, let me tell you. This is because we are specialists in cash flow financing bank. And number two, of the balance 10%, you have close to about 7%, which is liability group business, which is basically group lending security. So, but I don't call that security, by the way. But I treat cash flow as real security.
Okay.
So I want to just share that with you.
I take your point that cash is a very big security, but still the traditional way of looking at secured and unsecured is, collateral. So how much would be unsecured in that sense?
No, we have not specifically called out unsecured, so I cannot specifically pull out one channel. But like I pointed out to you earlier, cash is security. We should get this, and we should remember two things, by the way. We evidence the cash in the bank or assess the cash in the bank, and we lend to that. And then on due dates, it's not customer is paying you. We have the right to pull money from that account. It's the only product in which the customer has to pay you is credit cards. Everywhere else, we pull money from the bank. And that's a very big security, just for information.
No, the reason why I'm asking you about unsecured is Reserve Bank has told all the bankers to go slow on unsecured lending. So in your case, will this put some brakes on the pace at which you are growing?
No, we have been very stable about this. In fact, over a period of maybe 3 or 4 years, see, this is a starting stage of the bank. Obviously, we'll have more of, we'll have less of the secured lending. And as the bank is like 4 years now, continuously our extent of the unsecured facility, or so-called unsecured, what I call secured through cash, that is actually coming down. But whether it's through property or through this one, like I said, it's cash back. But your question, there won't be any breaks on the bank, so to say. We are tracking ourselves to it. We track ourselves to two things, Lata, and very important to note. I'm actually happy you asked this question. Two things to it. One is we track about what is the collection percentage. I told you 99.5%.
Yeah.
Number two, we track what is our SMA. SMA is it's a pre-NPA stage. That for our bank is 1.1%. 1.1. It used to be 2.2 even 1 year ago. It's coming down. And number three, NPA, I told you the numbers, 1.55 and 0.55. So we track these three indicators, and of course, credit cost. Our credit cost is only 1.1 or 1.2% for the year. So our indicators are stable, but more importantly, not because of numbers. You should track everybody, all your viewers and everybody should track what our pre-delinquency numbers are. And
yes, you want your SMA one. I agree with you. Just a very quick one last question, because you're out of time and there's another embargoed interview. What margins should we work with? 6.4 or less?
Yeah, around that time, around 6.4%, 3, 4. Because actually we have a lot of old, high-cost liabilities coming for repricing this year. And that is at 8.8, 8.9%. We're going to replace it with maybe 5.8, 5.7% money. So that's 3%, of that money is going to add to income. So
that's heartwarming for your investors. That's heartwarming to hear for your investors. Many congratulations. Thank you very much, Mr. Vaidyanathan, for spending time with us.
And let me tell you, Lata, over the last many years, you've been one of the people who give us a lot of tough times, questioning our liabilities and assets and all that. But I say that hopefully from now on, you'll have even lesser questions to push me on. So, but
I'm only asking I'm asking what investors ask us to ask. Thank you very much, Mr. Vaidyanathan.
Thanks very much.
Okay, anyway, that is a near 4% jump in that stock On that positive note, take a break and we're going to come back with another management. Ramesh Iyer of MMFSL will be joining us for their Q4 numbers. Welcome back. We continue with our results analysis, and it's another good set of numbers that we are looking at from MMFSL. Their net interest income has come in above street estimates. Their asset quality is the best in 8 years. Loan book has recorded a good 31% growth. Ramesh Iyer, Vice Chairman, Managing Director at MMFSL, joins us. Good morning, Ramesh. Thank you very much indeed for joining us. Well, first up, let me tell you what investors have been telling us, analysts have been telling us. What is very heartwarming for them is that after a bit of erratic move in the results in the last 3-4 years, this year for the last 3 quarters, it's been, steady, constant, good growth. Is this a maintainable rate?
So I have been talking about it even when there were some bumpy rides that we were having. That when you do a lot of work in semi-urban rural market, you do expect that this kind of, bumps happening because of the market conditions out there, and was in nobody's control when we had the COVID wave 2, when things really went bad. But as a model, we are very, very strong. We have a very deep reach. We have a good customer connect. And therefore, we do believe that maintaining this kind of growth when the market conditions are favorable is absolutely doable and possible.
What is the smell you are getting in terms of market conditions now? Because your tractors has actually contracted. The loan book has contracted a bit. So how is the demand looking like? Can you repeat this kind of a performance? It's a 49%, almost 50% growth in year-on-year terms. What are the, at least the next 2-3 quarters looking like?
So clearly we are seeing a lot of traction out there in every economic activity. We are seeing use of asset is very, very high. The footfalls are continuing to be very interestingly robust. And also the pre-owned vehicle is showing phenomenal demand out there. And, why do pre-owned vehicles show so much demand? For the low cost of investment, the returns are, the freight rates or whatever else is similar to that of a new vehicle. So people who probably have a short-term use will all go for a pre-owned vehicle. So overall, we see good demand out there. Sentiments are very positive. Tourism at its best. People movement highest happening out there. The monsoons have been favorable, while there are some discussions, but the water levels are pretty good. And the infra is doing well. So what else one asks for rural to do well? I think every front it's doing well, and we therefore believe. But the last comment would be, the price increase on vehicle will be another to look at when the disbursements will grow, because for the same volume, you will have higher disbursements because the price of the vehicles will go up.
No, I was coming to that. There is a likely price increase, especially in EV vehicles, but in others as well. Would you fear that will temper demand?
I don't think so. See, one should look at from the use of the vehicle. See, we work with a lot of this earn and pay segment, and they're all asking for more vehicle because the need is so high out there. And I just laid out various segments which is doing well. So when there is so much of demand up there, I don't think the price of the product, because these are not 1 year product, right? They use it for 5 years, 6 years. And the price has to be seen as a distributed over that period of time. And we don't see that the price increase is going to have any impact on the demand big time.
Okay, more general, now coming to your spreads, 7.4 is still good, though it's 20 basis lower than, a year ago. How do you see that panning out? After all, the cost of money is rising.
So one should look at it, 200 basis point is what we saw as an increase over the last 1 year or so. And in spite of that, we have maintained the margin. It only means that our ALM match is so good that we are not to incur the entire cost of borrowing. We had an impact of just about 60-70 basis point in terms of impact, which was almost passed on. We don't expect that the cost of money is going to go up any further, or even if it goes up, maybe a 25 odd basis point. In the meanwhile, we've got AAA ratings, so some of our borrowings cost has come down by at least about 20 basis point because of the rating change. We also, many of our assets qualify for the PSL borrowing, therefore there's a demand out there for that. And if we do see that the increase is beyond 25 basis point going forward, there could probably be an increase to customer also to the extent of at least 20-25 basis point. Therefore, protecting margin is not our concern at all at this stage.
Okay, so 7.4 maintainable, you're saying?
Yeah, it's definitely maintainable. We don't see that at all.
Okay. No, and I'll tell you why that question comes, because OPEX is up 23%, cost to income ratio is up a good 400 basis points over a year ago. So, I mean, why these costs? Why are these costs rising?
So one is it's a conscious investment in technology and people capacity, and that will all yield benefit as we go along when we look at even much larger balance sheet. Also, one has to compare these kind of costs incurred with the benefit that it has already brought in. I mean, look at the collection efficiency, look at the NPA drop. They all require some cost to be invested for recovering from all of them. So therefore, one should also look at where has this benefit gone immediately, rather than just looking at it one line item where the cost has gone. But some of the costs that we have incurred are a very cautious incurrence, and we'll see the benefit of it. As the balance sheet starts to grow with this cost already invested, we are looking at a 2.75 to asset as the number for the OPEX.
Oh, okay. Unsecured loans, how much is it? I'm asking because the Reserve Bank has cautioned lenders about not increasing their unsecured loans.
I mean, you look at our book is close to about 82,000 crore and we hardly have anything. It's a rounding of difference number at this stage. We are not a significant player in the unsecured loan space at all.
Okay.
And even if we were to get into, let's imagine we do some 2,000-3,000 crores of unsecured loan for a year or so, that will be a very, very minuscule number in the overall AUM.
Finally, would you need capital, Ramesh, anytime now? Your CRAR has gone down a bit. Obviously, you are using up capital, but will you be wanting to raise? After all, markets are in a kind spot, barely 4% away from all-time highs.
No, look at our even tier 1 capital. I think we have yet to consume sufficiently. At about 20% capital adequacy, we don't really raise capital, and we are making sufficient profits, which are also getting added back to the net worth. So we don't have any plans immediately, at least for the 2025 growth plan that we have put out. We don't need to raise capital.
All right. We will leave it at that. Ramesh Iyer, pleasure speaking with you, and all the very best for continuing this very good performance. The market is rewarding it. It's a 5.4% jump that the stock has seen. Okay, now with those micros, let's shift our focus and go to the macro space. After all, a month ended and we got some numbers. More importantly, the core sector numbers. Now, the core sector growth for March actually slipped, and it's come down, as you can see. to 3.4%, and that's a significant fall from the kind of highs we saw. This is the slowest in 5 months that we have seen, slowest since October. Sectors that showed poor growth among the 8 core sectors were electricity, cement, crude oil, natural gas, refinery products, while those that did well were steel, fertilizers and coal. Now, we also witnessed weak growth, I'll go sectorally, in electricity. We've seen a significant fall after a strong growth at the start of the year and, strong growth since November. Likewise, even cement slowed very sharply. As you can see, a fairly sharp fall in cement consumption. Not very encouraging considering, it's a down number, considering that this is the month when cement output should pick up. Steel, however, has had a very decent run. As you can see, a fairly decent performance being maintained. We now have the core sector data for the full year, FY23, because what we were discussing is March numbers. What are the longer term trends that we can see? Well, the FY23 growth in the core sector is at 7.6. That's impressive. But the slowdown versus the pre-COVID times is continuing. This is the average of 4 years that we have taken since the COVID year, 3%, and the average of the past 4 years before COVID at 4.1%. Now, however, while this is the overall core sector performance, coal is a very big outlier. The last 4 years, COVID years onwards, has shown a very good growth. So grown very sharply since FY20. Steel has also kind of held its own. It's doing almost as well as the previous 4 years before COVID. At least it's not fallen. It's maintained steady. But that's where the good news ends. If you come to electricity, the output has clearly fallen, the average growth of the last 4 years. And likewise in cement, which is a bit troublesome because that's the fuel of infrastructure. That's also growing at 5.4% for the 4 years compared to 5.7%. And refinery products, which is the largest contributor in the core sector, heaviest weight, has actually fallen pretty significantly if you take the last 4 year average compared to the previous 4 before COVID. In short, core sector done well in FY23, but still needs to catch up with the pre-COVID pace. Well, with that, we will go into a break. Very strong showing in the equities market. Let's check out what's happening in the commodities space. Manisha Gupta joins us. Manisha, what do you have for us today?
Well, some of that support in the equity markets could be coming in from the commodity markets, especially the metals as a sector, where yesterday the New York session was really strong and the Asian markets also have seen a bit of a buying coming in. Of course, the liquidity is low because China is out for the Golden Week holidays, but that's aluminum on your screens, 0.5% of a gain there. And the economic data, all of that has come in on the weaker side. The strength comes in on the back of China pledging more stimulus to boost growth, and that clearly has been the only supportive factor that we see right now, because the dollar index is also trading at 102. We've seen China manufacturing activity contract in the month of April, the lowest since December 2022, and not just manufacturing numbers, the service activity growth also has slowed in the month of April. We've seen housing starts decline. Same is the case with US numbers, which have come in on the weaker side, and that has weighed onto the markets there. The China construction starts were down 20% in the first quarter of this year as compared to previous year. So all of those numbers have been on the weaker side. But as I said, China has given a statement yesterday suggesting that they will be putting in more stimulus into the markets, ensure that there is growth not just in the retail sector, but the real estate sector as well. And that has been supportive. The ferrous metals, in the meanwhile, haven't seen much strength come in because of that. Iron ore prices have slipped to a new 5-month lows. We are trading at 105 right now. There are statements from Rio Tinto saying that the exports gained up by 15% in the first quarter. So there is that much more iron ore supply in the global markets. And the other company, WAL, also says that production has grown up by 5.8% in the first quarter. So there's enough iron ore in the global markets, but the supply in China clearly continues to decline. Not just iron ore, the steel prices also are trading at a 4-month lows. We've seen copper prices continue to decline as well. But the support clearly comes in right now because we also are looking at the inventories continuing to decline. We've started the month of May on a very positive note. Remember, in the month of April, the copper prices declined by nearly 4.5%. The support also comes in from the fact that when you look at the global inventories, they are trading quite low as well. So the LME inventories are trading at 2005 lows, and the Shanghai inventories have seen a decline by nearly 42% from their Feb highs. So on-ground demand seems to be coming up, is the reason we've seen the copper prices on MCX as well come back from 740 to 750 currently. But I do want to tell you on how the month of April has been. So 4.5% of decline in copper. Aluminum clearly has been an outperformer. Zinc fell by 11% in the previous month. And we've seen 12 to 15% of decline come in for steel and iron ore as well. But the markets do believe that a near-term bottom perhaps has been created. But then again, this week you have the US Fed, ECB meeting and the Reserve Bank of Australia also meeting. So that would keep the markets volatile.
Okay, thank you very much for that, Manisha. You're right about metals lending a shoulder to the Nifty. There are 3 stocks, Hindalco, JSW Steel and Tata Steel, among the top 5 gainers in the Nifty. But it's an across-the-board rally. 2.55 stocks advancing for 1 stock declining. So it's a very strong market as we hand over to Chartbusters. Thank you for watching Bazaar. It's a break time.